Good evening, this is Ayers, and I am just checking in from beautiful Boca Raton, Florida, which is currently hosting the Summer 2016 Medical Success Summit. Tonight I'm going to be talking to you about issues of phantom income. This is very important because it goes to how you set up a new urgent care entity. So in general, there are three types of corporate entities according to the IRS. The first is a C corporation. A C corporation pays taxes. The problem with a C corporation as a professional is if you own a C corporation, the corporation itself is going to be taxed, and then whatever dividends that corporation issues to its owners will also be taxed at the owner's tax rate. So in a sense, a C Corp requires what is called double taxation. The same income is taxed twice by the government. So to avoid that, professionals typically set up either a limited liability corporation or an S corporation. LLCs and S corporations are called pass-through entities. The reason why is whatever income is earned by the business gets reported to the owner of the business in the form of a Schedule K. The owner of the business then takes that Schedule K, they report that as income on their Form 1040, and then they pay the taxes for the business at their personal income tax rate. Now, the challenge with an LLC or an S-Corp goes to an issue called phantom income. So you could have $100 of earnings into an urgent care center. That $100 of earnings will be passed through to the owner's personal 1040, and they would be responsible for taxes on the entire $100. But this is often what happens. $100 of earnings of cash comes into the urgent care business. You have to pay debt expense from that. Or you may need to invest in the business. Let's say you need to buy a new x-ray machine or you're opening a new center. So at the end of the day, even though you have $100 of earnings, you may not necessarily have $100 in cash, or let's say $30 of cash or even $20 of cash. So what can happen is the $100 of earnings passes through to the owner's Form 1040. They owe, say, $28 in taxes, but they may only receive $10 in cash from the business. So then that creates a tax liability that the owner may be unable to meet. I've actually seen providers end up in situations with the IRS where they cannot meet these tax obligations. They get hit with interest and penalties and significant tax issues because they didn't plan their cash flows correctly to assure that they had enough cash coming into the business to cover those cash flows. So while I am not an attorney, I do have a master's in accounting. I am not a licensed CPA. Our intent here is not to give you tax advice, but is to make you aware of some of the issues that come up in the way that you structure an urgent care company. Here at Practice Velocity, we have helped over 150 urgent care startups, and we have expertise and we have relationships with experts in law and accounting who can help you set up your urgent care center so that you can avoid these common pitfalls. Again, here from Boca Raton, this is Ayers just checking in. If you have any additional questions, please feel free to contact us at the email address you see on your screen.